And the way that you swap is through a liquidity pool. So people put all of their coins in and then you can swap in and out of that pool. This is PancakeSwap right here. So you can see I'm actually exchanging Binance coin into Cake tokens and I'm using a liquidity pool to do that. Liquidity pool is a massive collection of tokens. So you have other people, and these are called LPs or liquidity providers, and they provide their tokens or just literally give their tokens into the pool to provide liquidity for other people that want to swap. The reason they do that is because they earn fees. Liquidity providers or LPs earn trading fees, and this is great. So you can actually earn fees yourself. If you have some coins, you can put them in the pool and you can earn some exchange fees, which is really great. Most liquidity pools will use an automated market maker system or an AMM. Back in the day in the stock market makers were actual people who did all that thing with their hands and bought and sold and actually facilitated trade between a buyer and a seller to big organizations. Now that is done on the blockchain by a computer system. The AMM will match a buyer and seller and will get a decent price for them both with the swap. What are the pros and cons of this? Well, DEXs are really decentralized, so no one owns them. Also, they're very low cost. You have massive access to really small altcoins, which you may want to go ahead and trade. They also offer staking and rewards. So like I said, put your coins in a liquidity pool and you'll earn trading fees. That is a way to increase the income that you get from your cryptos. There are also staking rewards as well to increase liquidity, so you get paid for that. You earn commission instead of paying it. Obviously, you pay it when you trade. There are security concerns for DEXs though. A lot of security concerns, especially smaller DEXs. There have been a lot of rug pulls, millions of dollars stolen, so that's definitely a downside of a DEX. You might just want to stick to the top 1 or 2 DEXs, and they are way too slow for day trading. We cannot use a DEX for day trading. We get no charts, we get no order book, we get no technical analysis, and they require a cryptocurrency wallet to go ahead and use them. Here is the pros and cons of a DEX versus a centralized exchange. You can read these, but essentially a DEX is very, very low cost. You get access to small coins. You get yield farming, so you can actually earn more. You can earn commission by putting your coins in, but it is very blockchain and very crypto. A centralized exchange is just like trading on the stock market or anything else. You have an actual company who is there providing you a product. You get ultra fast trading. You get all the pro trading tools. You get great charts. You get a lot of liquidity, which is super important when you're trading a lot of money. There are some downsides, but centralized exchanges are an absolute must if you are a trader. So what's the recap? DEXs offer swaps and yield farming. That's a positive. They only run on smart contract blockchains. They have pros and cons in terms of they're slow and they're also not great for day trading. And they also have security concerns if you go for the less well-known DEXs. We're going to have to use a centralized exchange to day trade and swing trade our cryptocurrencies. Unit 5, and we're getting into the good stuff. If you haven't done already, check the description for everything I'm mentioning in this video. Do like the video and subscribe if you haven't done already. Crypto trading strategies. This is what you want to know. So what are trading strategies? What are the best trading strategies? What type of investor are you? Are you short, medium, or long term, or are you a mix of these? And what is dollar cost averaging? Super important to know. Now this links with Unit 8. Everything I'm going to talk about from now on is really a build up to the end of the video where we're going to be trading. We're going to be going through trades, but you have to know everything first to build up to what we're actually going to do. You need to know the basics, so we're going to get into it right now. First, I'm going to come on to swing trading. Super popular. A lot of people do this with stocks, Forex, and cryptocurrencies. Swing trading is short and medium term only. This isn't a long-term strategy. You open trades for maybe a couple of days, maybe a couple of weeks, but with swing trading, you're looking maybe a few days, maybe a couple of weeks, depending on the trade. You use both technical and fundamental analysis for your trading, but we certainly rely on technical analysis for when we're getting in and out of our trades. And what you want to do with swing trading is just capture a percentage of a price move. So you want to anticipate a move in the price, either up or down, and then place your trade so that you get at least a percentage of that and make your money. One of the benefits of swing trading is that it requires less time. You don't need to be researching. You can use some technical analysis here to just get right in and start trading. You can definitely make some short-term profits. And with swing trading, what I would be using is the 1-day chart. If that doesn't make sense, it will do later on in the video. We're going to be using a 1-day chart for swing trading. Downsides of swing trading, could miss out on the longer term trends. You know, if you just invested in Bitcoin 5 years ago, you'd be up a lot now and you wouldn't have had to have done anything with swing trading. So that's definitely a downside of swing trading. And with swing trading, you can be stopped out a lot with short-term movement. So you actually may be right about a trade, but in the short term, the price could just move up in the wrong direction, stop you out of a trade, so you make a loss, but you were right about the trade. So that's just part of trading, one of the downsides of swing trading. Thanks to Investopedia for this image though. I'm going to use this to describe what swing trading is. Now we can use a chart, we can use some analysis, and some chart patterns to go ahead and swing trade. If you think this looks crazy, I'm going to explain exactly how to do it later on in the video. We can see a small cup and handle pattern right here, and we also have a consolidation period right here. These things are what swing traders use to trade. You can get into a trade around here, you can ride that is a swing, and then you can put some stop losses in place and basically get out. So a swing in the market, you've taken a percentage of that move and then got out of your trade and made your money. I'm going to be showing you swing trading and also breakout trading later on in the video. What is breakout trading? Breakout trading is slightly shorter term than swing trading, but it can be for the same amount of time. It really depends on you as a trader. You open trades for maybe even a few hours to a couple of days, and you mainly use technical analysis, but you need also to know what's going on in the markets and what types of news may move the markets as well. We can use specific chart setups for this, and I'm going to show you exactly how I trade and how you would go ahead and do a breakout trade later on in the video. We want to capture a breakout in the price. Now, what is a breakout? Well, there are specific things we look for that show us whether there is going to be a breakout or not, and that's how you trade. It requires way less time because you're really just looking at potential breakouts and you're putting your trades in. Definitely short-term profits with this one. We can use either the 1-day chart or maybe the 8-hour or 4-hour chart, depending on who you are as a trader. You could miss out on longer term profits once more. And again, short-term swings can stop you out of your trades, making a losing trade, but it may actually go in that direction. That happens quite a lot with breakout trading, so something to be aware of. Thanks again to Investopedia for this one, but this is essentially a breakout. So what happens is trade in an asset, let's call it Bitcoin, will actually go and consolidate like this. And we use these lines, and I'll talk about that later. This is actually what we call a wedge pattern, and it is possibly going to have a breakout from that pattern eventually. So this is what breakout trading is, trying to spot areas of consolidation that could then lead into a breakout. Place your trade, get that move and the volatility in the price, and maybe take advantage of it. We can see right here, this is the area of consolidation that we want to look for. Breakout traders will look for this to place their trades and essentially try and make some money when the price breaks out of that bracket. Another strategy is called scalping. Ultra short term, I'm talking intraday trades. You'll maybe looking at a 5-minute chart, trading 10, 20, 30 times a day even. There are computer systems that scalp as well. You may open trades for a few minutes to a few hours, certainly not overnight and not a few days. Only rely on technical analysis and nothing else. You trade off tiny movements in the price. Now this requires a lot of time, a lot of effort. You have to be watching the screen at all times, but you get hundreds of trading opportunities per day, definitely. So if you want to trade a lot, look at scalping. There are a lot of opportunities to trade with scalping that long-term investing just doesn't give you. Essentially what you're doing with scalping is actually trying to trade off other people's orders. If a huge buyer comes into the market over a very short period of time, the price may move up a tiny amount, let's say 0.25%. In Forex, it's going to be much smaller, but in cryptocurrencies, it might be 0.25%, maybe 0.1%. As a scalper, you're trying to anticipate that, get in off the back of their order and try and basically buy some crypto before they finish their buy and then sell it to them as well. It definitely requires more funds. It's very difficult and time consuming to implement, but this is what a scalping setup would look like. I have a 5-day, an 8-day, and a 13-day moving average on here, and you can see all of these swings. So we have one swing right here. Now remember, this is intraday. This is a 15-minute chart. So every candlestick right here is 15 minutes. If you don't know what candlesticks are, if you don't know what this chart is, don't worry. All of this is going to be explained as we go through the video. You can see though, this is an area where we could trade. We could try and ride this up and then sell up here. We can also ride this movement as well. Now these lines here are a very simple way to try and anticipate movements in the price. We also have a movement of the price here and we also have a movement of the price here. These are ultra short-term intraday price movements that a trader can take advantage of, and you can just make your profits like this. Now, one of the downsides is that it can move against you very quickly, but that is scalping. Then we come on to a completely different strategy called dollar cost averaging. This is not a day trading strategy. It's not a short-term strategy. It's a long-term investment strategy. Now, you are purely price agnostic. This means you don't care what the price is. You don't care how the price is moving short-term. You just put in money at regular intervals. You really trade off fundamental analysis, essentially meaning go and research a project, go and look at the tokenomics, go and look at the fundamentals. Is it a good project? Does it have good people? Does it have a good future? Yes, it does. I want to invest in that project over the long term. This is investment, not trading, and you don't have to deal with FOMO or fear of missing out because you're in for the long term. It actually requires little time. Really what you have to do is research a cryptocurrency or other cryptocurrencies that you want to invest in. Once you've done that, all you have to do is just go and set up your dollar cost averaging setup, and it's really simple. You don't have to trade the markets. Not interested in the short term whatsoever, and it relies on the premise that markets go up over time. Low cost, low, that should be a W, low cost, low stress. One of the big benefits of dollar cost averaging is the mentality of it. You don't have to worry about missing out. You don't have to worry about buying in dips. You're just going to drip feed investments over the long term. Mathematically speaking, there is no mathematical advantage to dollar cost averaging compared to lump sum investing. However, that's not really the whole story. So I'm going to show you some differences here. And of course, if you dollar cost average and you build up large positions in cryptocurrencies, you could face significant losses. If you go heavy into a crypto over the long term and you're not keeping up with the crypto and the fundamental analysis, that price could drop a lot and then you're in a loss. And because you're not trading daily, you can't really save that loss because you're not looking at the markets as a daily trader. But here is what dollar cost averaging would look like. All you do is choose how much you want to invest, and then you split that up over a time scale. So I've just done it once a month here. So let's say you've got $2,500 to invest in Bitcoin. So you start in May. Now, rather than putting $2,500 in,